Good morning. It's Jeffrey Christian of CPM Group. It's just after 10:30 in the morning here in New York on Tuesday, the 9th of December. It's a lot of things that we want to cover this week, talking about the markets and some of the political, economic, and fundamental factors that are at work here. Gold prices this morning were around $4,230 an hour ago when we were preparing this video or starting to prepare this video. Our expectation is that prices could show some weakness over the next week or two, but our broader view is that the price of gold will continue to rise, and that since we haven't seen much weakness in the first week of December, and given the fact that we have the FOMC meeting announcement tomorrow and the Fed's commentary, that scope for weakness may be passing, and we may see stronger prices going into the end of the year, and then much stronger prices in the first quarter for a variety of reasons, some of which I will be talking about today. Now, I wanted to talk about where the price of gold is now and where it's going. And as I said, our expectation has been that it's going to continue. I have to stress that CPM Group expects prices to rise both in the short and the long term, even though at some point over the next few years, you could see a cyclical pause or even a retracement similar to the one that we saw between 2011 and 2019. Our view has been since 2000 that we were heading into a gold and silver renaissance in which a stronger investment demand in more parts of the world, as investors rediscovered the value of having some of their wealth in gold and silver, would drive gold and silver prices to record highs over several decades, not over 1 or 2 years, as was the case in the period from the 1960s into the 1990s, but rather on a long-term sustained basis. And that's basically held up. Within that context, there are cyclical declines. There's a secular upward shift in the investment demand curve, which is driving gold and silver prices higher. But that doesn't mean that there aren't cyclical ebbs and flows that reflect fundamental shifts and developments, and also macroeconomic and international and national political factors that are there. We have been projecting prices above $3,000 to occur in this period, 2024, 2026, which would coincide in our projections that we've had for several years with economic and political problems. It's happening. It's within the context of that longer term positive gold price expectations that have extended really back to the 1990s. Many investor clients have been long gold accordingly. And again, I will repeat, most of our revenue comes from investor side, not necessarily producers. Producers used to be a much more significant part of our client base. They have shifted in recent years, and financial intermediaries, i.e. bullion banks, are an extremely small portion of our client base. Less than 1% of our revenue comes from financial intermediaries. The bulk of our revenue comes from investors. And our investors have been long accordingly, partly based on their own analysis and views, and partly based on the research and consulting that they get from us. Now, while our pricing and timing targets have been reached, this year most investors have chosen to remain long, given the historically enormous political, economic, financial market, and social problems, dysfunctionality, and risks that the world is facing. So, yes, you're there, we're there, we've done really well being long, but we don't necessarily want to get rid of our gold and silver. CPM Group has agreed with this position and has urged maintaining those long positions. Investors instead are hedging their long positions, and we have been structuring hedges for investor clients really throughout 2025, and seeing more and more high net worth individuals, family offices, institutional investors retaining us expressly to help them with that. And everything that I'm saying about gold right now pretty much applies to silver as well. So you have to understand that much from the beginning. Two more points. $3,000 gold seems really low at this point. And in fact, CPM Group does not expect to see $3,000 gold in the next decade. We do see a cyclical decline at some point in the next 10 years, but not in the next 2 years for sure. We expect prices to remain high and to move to further highs over the next 2 years. However, realism demands that we all understand gold has never been anywhere near $3,000 before February of this year. It's never been more than $3,000 since March. We're talking about prices above $3,000 for 9 months now. So $3,000 may seem incredibly low, but let's be realistic. It was a record price just 9 months ago. Now, that's important to understand because when we're pricing these hedges that are suitable for producers and investors and others, we're looking at prices that could drop down to $3,800 or $3,500 on a very small, short-term temporary basis. And right now, given what I was saying earlier about the strength going into the first quarter, such a decline might not materialize, if at all, until the second or third quarters of next year. That's going to depend on how politics and economics shake out. Our expectation is that politics and economics are going to be very hostile to real economic activity over the next several months. In January and February, we're going to start seeing economic data coming out of the United States, inflation conditions, employment, business investments, and other factors that have been delayed due to the government shutdown for 5 weeks in October into early November. And our expectation, as is the market's expectation, a lot of those are going to point to economic problems and issues. Right. So with that in mind, we have yesterday priced a 12-month hedge. You can lock in a minimum price of $3,000. It's an insurance policy. You can, if the price went back to $12,600, which is where it was 11 months ago, gold started the year at $2,600, rose to $3,000 by March, it rose to $4,230 today. If gold went back to $2,600 to where it was in January 2025, you could sell your gold at $3,000 and buy it back at $2,600, capitalizing $400 an ounce. So it's a protection. It's catastrophic insurance, if you will. And it's good for the next 12 months. So it covers that potential for a price decline in the second or third quarters of next year. And you don't have to see $3,000 gold for this to be profitable. If the price fell to $3,800, which is a technical support level at present, or lower, an investor could modify the hedge to take some profits out of it while maintaining its long position and protecting and maintaining some of that hedge if it wanted to. So we did this effectively in the past. The most dramatic was in March of 2008 when Bear Stearns went bust and was merged into JP Morgan at the U.S. government's work. Gold prices broke above $1,000 for the first time. We had a lot of clients who had been buying gold at $300, $500, $600, $700, $800, $900 an ounce. And we told them, stop buying gold over $1,000. Buy some $900 puts for August and wait until the price goes back to $900, sell those puts back, and then you can resume buying. It took 5 days for the price to get back to $900. So this kind of hedge works for intelligent investors. Turning to silver, silver prices have spiked higher. They got up to $59.47 today for the active February COMEX futures market, about $59.30 an hour ago when we were preparing this. And similar to gold, we do expect the prices to stay high and rise further. That said, I said it last week and I'll say it again. The silver price rose $10 in 5 days in late November, early into last week. That was not fabricators buying silver. Oh my God, I need silver for my factory. That was speculative and investor buying. And in fact, if you look at the silver price, it rose very sharply from $36 in late August to $59 today. That's not fabrication demand. You don't have a tremendous global shortage of silver. There's some locational problems in India and in London, but there's plenty of silver around, and fabricators are not pushing the price or pulling the price higher. It's investment demand. And an investment demand is partially based on realistic expectations of the price of silver, and partly based on marketing hype about a long-term, massive, persistent deficit in silver supply relative to demand. The marketeers say that by adding these dummy variables for massive amounts of silver investment demand. But if you do your math correctly and you look at total supply less fabrication demand, you don't have deficits in the silver market. You have investors buying enormous amounts of silver, pulling the price higher. It's not fabricators, it's investors. And you got to understand that, because fabricators need to buy silver to run their factories and to make their products. But investors don't have to buy silver. And investors can sell silver, as they did for 15 years from 1990 to 2005, 16 years. And they don't even have to be in the market at all. They can go away, as they were for much of those 16 years. So you have to understand the tentative nature, the fickle nature of why silver prices are as high as they are. That said, I'm not saying that the silver price is going back to $36 anytime soon. I'm not even saying it's going back to $40 anytime soon. I'm just saying you, as a realistic investor, need to understand what it is you're buying. Otherwise, you can buy GameStop or Pet Rocks. Platinum prices very similar. Price of platinum was around $16.68 this morning. It's risen very sharply since June. It has risen primarily because of investor buying, predicated on a report in late May that said, oh, there's this long-term persistent deficit in platinum, supply relative to demand. And you come up with that deficit by adding dummy variables for platinum investment demand. Investors don't normally take how much platinum they're buying. Investors who buy through ETFs, the ETFs report how much is being bought or sold in the ETFs. But a lot of platinum investors don't buy ETFs, they buy physical metal, and that doesn't get reported. So you take that out and you look at total supply less fabrication demand, you have surpluses. And you have surpluses for most of the last 50 years since we started producing supply-demand statistics for platinum supply and demand at a time when nobody else was publishing them. So it's a surplus market. The surpluses have shrunk sharply. The market's a lot tighter. But let's see what happens economically, and let's see what happens in the auto market in 2026. The platinum price has been rising because of investment demand. And you don't have to believe me. I know that there are some people who have this like psychological urge to say something in our comments. These are our buy and sell recommendations, intermediate term. Where do we think the price? If you're an investor, should you be buying or selling with a 2 to 3 year time horizon? And these are our buy and sell recommendations since we started keeping track records in December of 1980. That was a pretty good track record. It's based on our fundamental analysis. Ask yourself, if you want to criticize us and say we don't understand platinum market, compare your track record to ours. Sorry if I sound smug, but somebody used the term unrealistic skepticism. Yeah, makes sense. Palladium, very similar to platinum. The price has risen since June, and it's primarily been rising because of investment buying. There has been some increase in fabrication demand, but it's mostly investors. Now, I want to talk about some of the macroeconomic and political factors because they've become much more virulent and unavoidable over the last week or two. That doesn't mean that they weren't problematic before that, but the markets seem to be focusing more on it. We're making this video on Tuesday, the 9th of December. Tomorrow, the Federal Reserve Board's Open Market Committee is meeting today and tomorrow. Tomorrow, they will make an announcement. The market is 90% of the market is betting that there'll be a 25 to 50 basis point rate cut. That is predicated on softening labor market and problematic economic indicators. The market is concerned that that the economy is weakening, and the market is betting that the Fed shares that concern and will cut interest rates tomorrow. And we agree with that. We think it's likely because we do think that there are a lot of storm clouds hovering above the economy. But unfortunately, we don't have a lot of data for the U.S. economy because of the government shutdown, and we won't have it until the first quarter. It may be the last interest rate cut for a while. We just don't know. We'll know where things are in the first quarter. It may well be that the economy looks so much worse as the data comes out in January and February that the Fed cuts rates more aggressively. Or it may be that inflation is much more problematic and the Fed is more hesitant to cut rates. We lean toward the former outlook right now. What's more important than the Fed's interest rate cut will be the projection materials, not for the economy. They tend to be overly optimistic all the time. But more important will be their projections on what their policies will be over the next year or two. Will they be looking at and saying that they expect interest rates to fall further in 2026 and 2027 or rise? That'll be much more important, as will Chairman Powell's comments in the press conference that he has after the release of the FOMC statement. There could be a lot more volatility across markets following the meeting and following Powell's comments, and there could be some downside too, in case the projections and the press conference seem more hawkish or at least less dovish. So it's something to pay attention to tomorrow. We'll talk about it probably on Friday. And there's been a series of issues with international political developments, primarily in Europe and regarding Europe, Russia, and Ukraine, that are again, these are issues that have been growing for at least 9 months, but they're growing more unavoidable in the public eyes. The U.S. government is clearly siding with Russia rather than Europe. They're denying it now, but the U.S. administration said originally that their 28 points for settling the Russian invasion of Ukraine came from Russia, that those were Russia's objectives. Ukraine give up land, Ukraine never joined NATO, half-hearted support for Ukrainian defense on the part of NATO. Those are all the things that Russia wanted, and the administration initially said, yeah, those were Russia's views. Now they're denying it, but that's what it is. They're saying several things, very important ones. First off, last week, German Chancellor Olaf Scholz said, he told Zelensky in public that Ukraine should not view the U.S. government as an ally. The Finnish president, Alexander Stubb, told the rest of the EU leaders and Zelensky in the same meeting that it could be dangerous to allow Zelensky to meet privately with Kushner and Witkoff. Let those 2 points settle in. These are what our long-term 80-year-old alliance partners are saying about the U.S. government. And the U.S. government's basically saying the same thing. Get to that in a second. The EU 2 weeks ago put together an agreement and publicly said, we have an agreement within Europe to finance Ukraine's war through 2026 and 2027 without involvement of the U.S. government. We're preparing to move forward without the U.S. government because the U.S. government is showing that it sides more with Russia than it does with Europe and Ukraine. It no longer considers the U.S. government a reliable, dependable ally. And in case you think that's just a European attitude, take a look at this. This is a link to the United States. The White House released at the last week of November the National Security Strategy Report. And this is a link to the White House document. It's about 30 some odd pages, 31 pages or so. And you've got to read it to the end. It talks about restoring Russia's place in Europe, which in Russian minds means, hey, we control Eastern Europe and we own parts of Poland and all of the Ukraine and all of the Baltic republics. It sides with Russia against NATO and Europe. And it wants to intervene in European domestic politics to reestablish what it calls civilizational identity, by which it means nativism, keeping foreigners out of Europe, keeping immigrants out of Europe, Islamophobic, unrealistic, racist. In 2000, I was giving a speech in London on the gold market, and I was on a platform with a fellow who had been knighted for his work as an economist, saying why the US dollar had to collapse. He gave this fabulous speech. We have a copy of it that we refer to from time to time. This is the year 2000, maybe it was 2001. And he got up and he said, I have 40 minutes to speak. I'm going to spend 20 minutes talking about my work saying that the US dollar has to collapse, which earned me my knighthood. And then I'll spend 20 minutes talking about why my life's work has been wrong. And what he focused on was the U.S. economy and political system compared to Europe and the rest of the world. And he said, if you look, the United Nations population projections have European population dropping for several more decades from 2000, but then rising. And he asked the demographers at the United Nations, what are you looking at? And it was immigration from Africa and Islamic nations in the Middle East and North Africa. People fleeing political, military, economic, religious, and cultural oppression coming to Europe. And the biggest embarrassment for the French government at the time was a refugee camp at the French mouth of the Eurotunnel, the tunnel that connects France to England, because people would make a beeline. Once they got into Europe, they would make a beeline for the tunnel to try to get to the UK. Because once you're in the UK, you can get to Canada or Australia or the United States easily, and you can build a future for yourself and your family. In Europe, you wind up on the dole. And he said, this is a very big problem. And this was 25 years ago. Yeah. So it's not a new issue. It's something that's been around really more than 25 years. But it's there. And the Trump administration has said, we, the United States government, need to intervene to stop this immigration into Europe and restore a white European cultural civilization. Wow, that's not the kind of stuff I want to talk about at Thanksgiving. Here's something from yesterday. Jamie Dimon of JP Morgan. There are people who don't like him, but you have to say, guy's really smart. He's really well informed. He's done very well for himself, and he's done very well for the world. If you actually look at what JP Morgan has done globally, culturally, supporting organizations, supporting anti-poverty programs, you've got to say, you might not like the guy, but he's pretty smart and he's pretty successful in not just for himself, but for the world. But he gave an interview, and this is like a 3-minute clip of a presentation that he made at a Reagan event yesterday. And it's definitely worth watching, especially because it's only like less than 4 minutes long. And he basically was talking about Europe having these same social problems I've just been discussing, and how they're getting worse and they're getting difficult. And there's also perhaps awakening up on the part of European leaders, political as well as economic and business leaders, that these things need to be dealt with. And these things have been going on for at least 5 decades, although they're growing less sustainable over time, and they're getting to critical levels. The same way they're getting to critical levels in the United States and Japan. It's all very interesting, and it's all coming together in real time this year and next year. Next Monday, the 15th, we will be working with Silvercorp. We're going to be doing a live webinar. Lon Shaver of Silvercorp and I will be discussing the state of the long-term gold and silver renaissance, which I referred to earlier and in last Friday's video. We'll be discussing the state of that renaissance, the reawakening of investors globally to the value of having gold and silver in their portfolio, and what central banks are doing with gold. It's an online seminar. It's sponsored by Silvercorp. You can go to our website and register. I encourage you to plug in next week, 11 a.m. in the Pacific time, 2 o'clock in the Eastern time. It's going to be very interesting. That's all I have for now. You can go to our website. You can buy our research. You can read a lot of free reads and see a lot of free videos. You can send us an email at info@cpmgroup.com. In the meantime, take care of yourself. Go to our website and register for next Monday's webinar. Try to do something good for people around you and something good for the world, because it's getting scarier and scarier. Take care.